Dear investors, welcome to yet another episode of our podcast. Certainly, these are very uncertain times that we live through today. We are witnessing high uncertainty on growth and inflation dynamics, which is leading to a significant volatility in asset markets. And that's not only in India, it's across the globe, very, very evident. So if you look at equity markets across the globe, be it the US market or the emerging market economies like India, we have seen a sharp fall. Even commodities, if you look at last month, have corrected significantly, and also bond yields have seen a significant increase. So amidst all these, currencies, mainly in emerging markets, have taken it on the chin. So has the Indian rupee. When we kind of phase through or look at markets, we kind of look at equity markets, bond markets, commodities, etc. But usually we do not look at currencies. And currencies is one important barometer of how the economy is doing and what kind of things you could expect on the currency front. So if you look at even the Indian rupee has been depreciating steadily and has hit all-time lows against US dollar in June. It has breached the 79 rupee per dollar mark for the first time. And if you look at the YTD year-to-date depreciation, it's already seen a 5.9% depreciation against the dollar. What is causing to this depreciation in the rupee? If you look at one important element, there are few things that are leading to this fall in the rupee. Most importantly, the impact of crude oil prices. If you look at crude oil, because of geopolitical tensions and ongoing conflict between Russia and Ukraine, has been staying above the $110 per mark. Given that India imports more than 80% of its oil requirement, this does not bode well for the current account deficit, and therefore the rupee depreciates. The second reason that is leading to that depreciation is given the global central bank stance towards aggressive monetary policies to tame inflation pressures that we witness today. This has been the most aggressive policy from central banks since 1980s. If you look at the US Federal Reserve, has already hiked rates by 150 basis points this year and is expected to increase further rates by 75 basis points in the next, and followed by another 50 basis points thereafter. So higher US interest rates kind of dim appeal of riskier assets in emerging markets, and this is leading itself to a very strong dollar, as we see some flows repatriate to take advantage of high yields in the US, despite inflation running high, but still the attractiveness of the bond yields in the US as compared to what they were prevailing before, the US dollar kind of appreciates. And given that US policy is most aggressive as compared to the likes of other developed economies, the dollar index gets a boost. Therefore, you have seen the dollar index scale up to a 2-decade high of 105, where it stands today. So as we see that, the foreign investors flee from riskier assets to the safety of US treasuries, given the uncertainty, there has been a lot of selling from foreign institutional investors. In this year, 2022, so far, foreign investors have pulled out about $28.4 billion from equities. And if you put it in contrast, the year where we saw a significant FII selling was in 2008. That was the year of global financial crisis. In that year, it was closer to $12 billion, $11.8 billion to be precise. And this year, we already seen $28 billion, significant selling as compared to any time that we have witnessed before. In this month alone, we have seen the foreign investors sell out about $6.3 billion of Indian equities. It is one of the biggest monthly FI outflow from Indian stocks since March 2020, which was the month where we saw selling because of COVID. Another reason that kind of fundamentally puts pressure on Indian rupee is if you look at the India's trade deficit has widened sharply to a record of $24.3 billion. That was in May of this year. So May's trade deficit was pushed up by a surge in imports, which rose by close to 63% to $63 billion, while exports rose only 20% to about close to $39 billion. India's gold imports also in May jumped to 670 by 677%. Of course, there hasn't been a base effect, but still it was significantly higher than most months that we see. It was at 101 tons versus an average of close to 40 tons that we usually see in a month. So lower global growth further will mean that the trade deficit will be under pressure. We may see higher trade deficit and therefore further stress on the current account. So fundamentally, we could see more pressure on the rupee. Uh, Also, given the fact that portfolio outflows do not help, so one could expect that weaker rupee in light of higher trade deficit could continue to prevail, and rupee may keep continue to slide further unless we see a meaningful correction in, say, oil prices, which will bring down our import bill, or we start seeing significantly change in attitude from foreign investors, which is towards selling currently towards more buying interest. Weaker rupee is supportive of assets like gold. So have an allocation to gold, as we kind of always suggest within the 12-80-20 allocation, that you need to have an allocation to gold because it is one of the best portfolio diversify available to Indian investors. Uh, Given that we talked about rupee depreciation, but if you were to put in light with other emerging market economies, rupee has depreciated relatively lesser against dollar as compared to many other emerging economies, because we have a lower inflation differential, we have relatively high growth as compared to other economies, and we have more as a political stability in the economy as compared to many other emerging market economies out there. So most commodities which were impacting inflation earlier are showing degrowth on a one month basis. There have been measures like Indonesia allowing palm oil exports. There has been expectations of slowing global growth, and Indian government measures like export taxes on steel, etc., is helping lower inflation pressures. So is inflation peaking for now? It's very difficult to say, but supply side issues are unlikely to be resolved, and there could be many surprises because of the geopolitics uh, that prevail today. Demand destruction due to lower liquidity or higher interest rates could dampen inflation, but at the same time hurt growth, which is now getting priced by the markets. From an inflation perspective, oil remains a joker in the pack and could impact India more if it moves higher from current levels. One important thing about what will drive oil prices, one near-term indicator is the Biden visit to Saudi. If that helps increase supply, gold or oil prices may inch lower. There will be a close watch on the Ukraine-Russia situation and the European decision on embargo on Russian oil. That needs to be watched closely whether that gets implemented or not. So that remains on the growth inflation dynamics. But coming to closer to our economy, the Indian economy overall is doing well. High contact services part is still recovering, and it's recovering very well. The sectors like hotels, media, airlines, autos, etc., are seeing good traction. GST collections continue to be strong. Economy shows signs of further growing. The momentum continues. If you look at indicators like e-way bills, which grew 85% YOY, of course, there was base effect on account of COVID last year in May. Even the toll collections are up 95% YOY, and power demand continues to run strong. So telling that economy overall has been reasonably doing well. Even if you look at the capex growth has now inched up to a 2.5-year high, which says that there is green shoots visible in the economy. At one end, economy continues to gain traction. On the other hand, from a valuation perspective, valuations, because of the correction in markets, have become reasonable. From a market perspective, mid caps continue to trade more expensive than large caps. And given the trends that we are seeing, large caps kind of are a better place to increase allocations at this point in time. The earnings growth is also supportive of valuations. Earnings growth aided by cyclical uptick in the economy. We have been saying that, and we are still continuing to see the signs of cyclical uptick remain intact for the Indian economy. From an investment perspective, I think the trends of unorganized to organized still prevail. Large companies becoming larger is also a trend that continues to stay strong. Uh, Financials as a sector, because of the NIM expansion and increasing interest rate scenario, is also supportive. Consumer discretionary spending in likes of autos, etc., are is also showing signs uh, of stronger growth coming back. So I think this could be a good time to increase allocations. One thing that is, leading to a sentiment impact is the continuous or relentless selling from foreign portfolio investors. So overall, what we are seeing is, given Indian markets have relatively fallen lesser, currency has relatively depreciated lesser as compared to many other emerging market economies. Uh, there are outflows on account of rebalancing. Overall, there are outflows in emerging markets, but within emerging markets also, there are certain economies like Indonesia, Brazil, Thailand, Malaysia, which are seeing positive flows, and likes of India, Taiwan, South Korea are seeing negative flows. So probably given the valuations are becoming reasonable, currency also depreciating, there could be at some point in time, with some further correction, the foreign outflows that we are seeing may continue to slow down, and barring they are across emerging markets significantly heavy. But the rebalancing trades could slow down on account of that, valuations becoming reasonable and currency depreciation. From an Indian market standpoint, any signs of cooling of inflation will be positive. Two factors that could impact and that needs to be watched very closely is oil and monsoon. If oil prices come down and monsoon is good and proper, and agricultural production is reasonable, then probably India is will be better poised and will continue to see the cyclical recovery that we are seeing. So from an investment standpoint, I think asset allocation in this time is extremely important given the uncertainty in growth and inflation dynamics that we see. Uh, the 12-80-20 allocation should really work well. And if you are not allocated in that manner, if you're more on the fixed asset investment or fixed investments at this point in time, it's a good time to increase your allocation to equity and gold both, given that where we stand from a equity market standpoint, and given the role that gold can play as a diversification in your portfolio. So asset allocation will help you tide through these uncertainties and will help you prepare to take advantage of the upcoming cyclical recovery in economy. And also from a global market standpoint, any uncertainties that could impact your investments, I think gold could help you diversify from those uncertainties. So please asset allocate, stay invested, build your portfolio. This is good time to go ahead, stick out your neck and build your long-term portfolio.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.